Hey, we are live Sunday, as we are every week here on Let's Talk Money at 1 p.m. Eastern, 10 a.m. Pacific. I want to thank everybody for joining us. It just gives us a chance to talk about a topic of the week, and then reach out to the community, answer some community comments, and just have that back and forth that we don't get to have in those regular videos. Thank you for being here. I see some people joining in. Go ahead and let us know where you're coming at in the chats, where you're coming in from, and love to get started here. Like I said, we do these every Sunday, 1 p.m. Eastern, 10 a.m. Pacific. And this week it's going to be something a little bit different from what we've been doing lately. We're going to be talking about some of the easiest ways to get those high yields and to minimize your risks in dividend funds. So lately we've been talking a lot about individual stock picking stocks, and this weekend we're going to talk about kind of how to reduce some of your risks and still get those high yields with some of these funds. Got some great dividend funds lined up for you, talking about what to look for, some of the risks in them, and then even if you're not interested in dividend funds, even if you just want to pick stocks, still stick around, because I've got a strategy that you're going to be able to use to use dividend funds and individual stock picking together to really get the best of both worlds. You're going to get lower risk, you're going to get market returns and less stress from those dividend funds, but you're still going to be able to make those higher incremental returns from picking stocks. So great strategy. I use it myself, and we're going to be getting to that right after we talk about these four dividend ETFs funds that I like, and that most of them I invest in my portfolio as well. See some people coming in. All good from Sealy. Greg from California. Thank you, Greg, for being here. Greg's a great member of the community, always commenting and adding his feedback into the videos. Love that. Darnita, how are you? Saw you last week here. Ex-dividend. Nina, thank you. Everybody, thank you for being here. I want to get started because, like I said, I'm really excited about this talk about the dividend funds. We love talking about stocks, but there's a lot to be said for just getting a big portion of your portfolio in these funds to diversify your risk, a little bit more stress-free investing strategy. So we're going to do like we do on every live stream every week. We're going to start off with some community shout-outs. Love the comments I get every week. Appreciate everybody out there in the community with your feedback, your advice even. I mean, this is a two-way street, so I learn from you all the time. Then we're going to be highlighting a few of the videos we did last week and some preview of some of the videos coming up. And then we're going to get into that dividend funds and that strategy to use funds and individual stocks. And of course, we'll always leave time for individual Q&A at the end. See some more. Well, from Ireland, got some Canadians, Queens, New York. Thank you for being here. And let's start with those comments, because I love all the comments I receive. I try to respond to each and every one, and got some great ones this week. This first one is from Badass, which love the screen name there. And this was on our portfolio update last week. We did talking about some strategies to avoid or strategies to survive the next stock market crash. Not saying it's going to be yet this year, but a stock market crash will come. It's just the nature of the markets and that human element in the market to get over exuberant, and then obviously on the other way down, seeing the crash coming. So just some strategies to talk about, and why I think a stock market, not necessarily a crash, but weakness is coming over the next year or so. And Badass had to say that while there's no crash. Well, there hasn't been a crash. There has been a big difference in ratings and prices between sectors and geographic locations. He makes the point that China and European financials, like I talked about in the video, are quite cheap. And again, I think this is a once in a lifetime or once in a generation opportunity to get into some of these domestic Chinese companies, these companies that are going to benefit from that long-term rise of China. And European financials, I mean, they've been beaten down for so long. They've got extremely low price to book values compared to their U.S. counterparts. Some of that is structural to Europe. Europe has negative interest rates on a lot of their 10-year bonds. people are paying the governments to hold their money, in these 10-year treasuries. And obviously with financial companies, with banks and insurance companies, if they're lending out on that short-term rate and getting their assets earned those long-term rates, if those long-term rates are near negative percentages, then they're not making any money. But still some upside in European financials. And Badass makes the comment that usually crashes happen when the market is as expensive and nobody is expecting a downturn, and the market doesn't have this feel. And I'd agree with some of that. Obviously, that it's always best to look for value where you can find it. So some of those sectors and some of those geographic areas like China, like European financials, even in the States, like like maybe real estate and some of the other sectors that aren't very expensive, you can look for value in there to help protect yourself from a stock market weakness or even a full-blown crash. What I would say is that if you look at the history of stock market crashes, typically there have been people that have been calling a bubble or calling those overvaluations. The only problem is they're wrong on timing. You get all these guys coming on CNBC saying, I called the 2008 crash, except they kind of leave out that they were calling it in 2003. Because that's when we started to see a lot of this asset bubble from the mortgages and those collateralized debt obligations and other derivatives start really getting out of hand. Of course, they were 5 years too early. So I mean, there are people that expect a downturn that are calling for it. It's just the problem with timing there. And I would agree, though, also that right now there doesn't look to be any huge forces that are pointing to a crash. There's no huge asset bubbles, other than I will say the corporate bond market is if you hear one thing most about asset bubbles and how the market is overpriced right now, it's in this corporate bond market. You've had 10 years of near zero rates through most of the developed world, and especially here in the United States. And corporations have just used that, rightfully so, to borrow billions, hundreds of billions, even trillions in debt. And then a lot of that is just going towards financial engineering. So buying back their own stock, increasing their dividends and those kind of programs. So not necessarily things that they can use to grow the company with that debt, but just to make the balance sheet look better. Not necessarily to make the income statement look better. Earnings per share, obviously, when you buy back billions of your own stock, then you've got less shares to spread those earnings over. So earnings per share goes up. So that's a lot of what we've seen over the last 10 years is that revenue, so sales, has been really flat. I mean, it's been really sluggish overall top line economic growth. But that earnings per share has continued to increase for corporates because they've been buying back so much of their own stock by issuing this debt and using that cash, that earnings per share has gone up, and of course, then the stock market has gone up. So corporate debt is really a problem, but with rates where they are and likely to be lower for quite a while, the Fed is even talking about cutting rates now even further. There doesn't really seem to be that impetus to send that corporate bond market into a full-blown crisis and that kind of thing. That doesn't mean that we can't get a 20% correction or a bear market, technical bear market like we saw last December, just if corporate earnings come down. We were expecting a corporate earnings recession this year, which is 2 quarters of negative corporate earnings growth. And a lot of those things, from the trade wars and just lower profitability among corporations, that could easily send us into a 10%, a 20% correction. So not necessarily a crash maybe, but there is some cause to be concerned, and things you can do to position for that. So thank you, Badass. Love the screen name and love the comment. I appreciate that. This is actually something we're going to look at in a little bit, but I wanted to get to our second comment here from G. Stroud, great member of the community, fellow Marine, so Ura Semper Fi there. But he's asking here, he's a little confused about the taxation on REITs and MLPs. How's that different? How do you use that in different portfolios and that kind of thing? Now, I think what kind of confused him here is in the 2019 stock market portfolio that we have, the dividend portfolio, and it's been doing excellent so far this year. Check it out if you haven't seen that yet. I think I leave a link in the video description below. I have to check that out, but look for that, because that's 18% so far this year, over the market by about 8%, which the S&P 500 is right around that 10% as of last week. So outperforming the market. But what I'm doing in there is I'm holding an MLP fund. So the Alerian MLP ETF, the AMLP, actually one of the funds that we'll talk about later on in the live stream today. And that is not a traditional MLP. It holds MLPs in the fund, but it's treated on a tax basis as a fund. So that is taxed a little bit differently from MLPs. Generally with MLPs, what you get, and MLPs are an excellent investment. I highly recommend. I've got quite a few videos on the on the channel about it. It's basically these midstream, usually midstream assets. So these companies buying up energy pipelines, storage facilities, processing, that kind of thing, and then they charge the other energy companies fees to use those assets, and then they end up sending the majority of the profits off to investors. It's set up as a partnership, so the MLP itself doesn't get taxed on corporate earnings. You don't get that same double taxation that you get with other stocks, right? The corporation's paying taxes, and then you're paying taxes on any money you receive from that. So MLP is a very efficient way to hold these assets. And what I love about them is most of that dividend that you receive from MLPs is actually counted as a return of your investment. So you get maybe a $2 dividend on a certain MLP each year, right? $1.60 of that, it's usually around 80%. $1.60 of that is going to be counted as a return of what you invested in the company. So it's going to reduce the cost that you paid on the shares by $1.60. No tax effects right there immediately. Now, when you go to sell the shares, then you'll have higher capital gains tax, because you bought the shares for lower and then sold them for higher there. And then the rest of your dividends are counted as income. So what you want to do with MLPs, you want to hold those in a regular taxable account, so you can take advantage of that capital gains tax and that special tax benefit. Now, REITs, on the other hand, these real estate investment trusts that hold real estate assets and then rent them out and send that huge dividend check to investors. REITs, a lot of that dividend that you receive is often going to be counted as income. Okay, it's not necessarily qualified dividends like with a lot of your other dividend stocks that are lower tax rate. So what you want to do with REITs is hold those in an IRA or a Roth, some kind of a retirement account, so you're not paying taxes on those dividends until you withdraw those in retirement. It's taxes are always a fun, interesting subject, I know. But just some things to understand, things to remember to get the most out of your dividends. Save a little bit on taxes, and let me tell you, working with private wealth clients, when I used to do that with high net worth individuals, taxes is where it's at. Taxes is where you save, where you make the most money. All the rest of us schlups out here paying our taxes. The rich, they get rich by finding out these tax breaks, finding out these tax strategies, and using those to their advantage. So understand the difference between REITs and MLPs here and how to use them. Our next comment, so thank you, GE, appreciate that. And our next comment here is from Sean, really talking more about the business side of things. Would you recommend setting up a business? So any kind of a business you start, setting it up as like a sole proprietorship starting out, or he calls it DBA, or doing business as. Basically, it's just everything from your business goes on your own taxes, personal income taxes. Or would you set it up as an LLC S corporation, right? So an LLC is a limited liability corporation. It's a pass-through kind of a partnership kind of deal with this S corporation designation. Now, I don't want to get too far into the accounting and all that about it, but it is something to think about if you're thinking about starting your own business. And I think everybody should have that income insurance that comes from starting a side hustle, starting a business. There's a lot of great tax loopholes, tax benefits you can get from having your own business, and you can pay your kids some of that. Put that money into their retirement accounts, and you take that off of your sales or off of your income, so you don't have to pay taxes on it. A great way to shield some of that money on there. Also through that last 2018 tax reform that we got, a lot of great benefits for business owners in there. You can actually deduct, I think it's like $20,000 off of your partnership or off of your small business, and not pay taxes on it. It's just free money. It's not taxed as income. So definitely recommend everybody checking out some of the videos we have on the channel here about side hustles, about starting your own business, some of these online strategies that I use, and doing that. Now, to Sean's question, there are, when you set up an LLC and an S corp to take advantage of some of these tax benefits, because with an LLC, and again, I don't want to go too far into the accounting, because I want to get to our dividend funds here real quick. But you pay less taxes. You can shield some of your money from the payroll taxes that most companies have to pay. But there are fees to setting up and maintaining a limited liability corporation and an S corp, that kind of thing. So normally, I've heard you don't think about it usually until you reach about $100,000 in sales or income. And that's just because the fees and the setup behind formally incorporating your business outweigh those tax benefits. So I just this last year, early last year, I started formed my own LLC because I kind of reached that high watermark where I could start shielding more income from taxes by using that LLC rather than just having it under my name. So we've got exams tomorrow. I just saw somebody have exams tomorrow, but oh, okay. For some reason, I thought you were talking about the CFA exams, which it just struck me. I think that was yesterday. So if anybody's here, just got done with the CFA exams, give me a shout out. It's been a long time since I've thought about that, but yeah. So now, and again, I love all the comments. Thank you, everybody. I appreciate it. I appreciate that community that we have, and all the comments I get, the feedback and the advice. Now I just want to go over real quick, a recap of some of the last week's videos, and then a preview of the week's videos we've got coming up, because we've got some really neat ones coming up. I think that are going to help you not only on dividend stocks, that topic that we cover here, but on some passive income investments that I'm going with Wednesday and Friday. So last week, completely dividends week. We had two dividend videos on Monday and Wednesday about kind of strategies around the payout ratio and the ex-dividend date. Some really interesting strategies that most investors usually don't think about. Usually think about dividends as kind of buy and hold and that, but I shared some strategy with you to really take advantage of certain dates around dividends, so that was fun. Friday's portfolio update is always the highlight of my month. I love looking into our dividend stock challenge portfolio and seeing how that's done compared to the market and some of our picks in there. Like I said, 18% year-to-date return against about a 10% year-to-date return on the S&P 500. So happy with that. We actually shielded a lot of our portfolio from that May sell-off in stocks by repositioning into real estate and bonds and some other stuff. Next week's videos, like I said, Monday, tomorrow, got a really interesting one, high yield stocks ranked. Okay, this is a very highly requested video. Everybody asks me, especially with that portfolio that we've got, why I started the limit, why I only looked for stocks with a 3% dividend yield or higher. And most of them have that 3 to 6% dividend yield. Why didn't I just go for dividend stocks of 12, 15%? Some of those very high yield investments, those very high yield stocks, and it's something I'm going to talk about tomorrow. And I've got a portfolio of 5 high yield dividend stocks, 6% dividend yields or higher, and I'm going to rank those. I'm going to share why I picked those and what are the risks in picking those high yield stocks. Because what's really interesting, and you'll see this in the video tomorrow, what is very interesting is of those 5 dividend stocks, from 6% yield all the way up to, I think one is paying a 15% yield on that investment. The 6% yield, the 2 that are right around 6% yield, were actually the best performers over the last 3 years. One of them's a 30% annualized return over the last 3 years. So basically doubling in the last 3 years, but it only pays a 6% yield. So definitely you just can't look at that high yield. You can't just look at that yield when you're looking for that highest total return. But I'm going to talk about that tomorrow in tomorrow's video, how to find those high yield stocks and that high total return, and kind of some of the risks to watch out for. Wednesday and Friday, we're going to switch into some passive income ideas. So Wednesday, I'm ranking 18 passive income ideas. Most of which I use myself on a monthly basis. Which are the most passive, which are the most or the easiest to set up and make money, and then some of them that might take a little bit longer to actually make passive, to set up, but they're going to make you thousands a month. So very important video coming up Wednesday, and then Friday we've got passive income investments, which are going to be a fun one. Kind of a mix of investing and passive income. So now I want to get to these dividend funds ranked, because I think this is a really interesting strategy of using these funds not only as an exclusive part of your portfolio, so just investing in funds, but actually using it in a strategy that I'm going to share with you after we look at these 4 funds that I've picked out and talk about. So there are some factors that lead to dividend outperformance. Okay, everyone on the channel knows I'm a huge believer in dividends. Because they just outperform the market. You get paid to invest. That dividend is always, every year, that dividend is going to be a positive cash return. Whether stock prices go up or down, you're always going to make a positive return from those dividends. And then on a total return basis, dividends just outperform. I looked at some Morningstar research just this last week, kind of researching for this live stream, and there's really 2 factors that lead to that dividend outperformance. You've got, typically dividends are in higher dividends, of course, are in sectors with a lower valuation. You've got utilities, you've got consumer staples, a lot of these sectors that might have a little bit slower growth than tech, than biotech, than a lot of those other sectors. But it's so investors aren't paying for that growth; they're paying for the actual cash flows and that kind of thing. So you get valuations that are a lot lower, and you got that value effect. Okay, typically value stocks just outperform growth stocks. Okay, because generally people jump into growth stocks, they bid the price so high, and then that growth doesn't materialize, or we get some kind of a stock market correction or a crash, and those growth stocks just get slammed. They just get hammered, while the value stocks tend to do a little bit better. They don't necessarily miss the market crash completely, but they don't fall quite as bad as growth stocks. The other side of that, or the other factor that leads to dividend outperformance, according to this research, was more stable cash flows, right? And this kind of feeds into that whole idea that we just talked about. Really, is just that dividend stocks and high dividend stocks, generally these companies have more stable cash flows. Of course, that's why they can offer these dividends, because they know that they're going to have money coming in regularly to grow the company and pay this dividend. And of course, that's just rewarded by Wall Street. That's rewarded by investors when you have a company with stable cash flows. So, now I want to share 3 factors before we get to those 4 funds. I'm going to show you 4 funds, rank them, 4 high yield funds that I think you can add to your portfolio. Great picks. But I want to share 3 factors that you want to look for when you're trying to pick dividend funds. Okay, everybody on the community knows I'm not just about just putting out a list of stocks to invest in or funds to invest in. I want to give you the tools here to do your own research, to pick your own funds. If you don't like these funds, or maybe in the future if you want to change funds, I want to give you the tools to be able to pick these yourself. So whenever you're looking at an ETF, an exchange traded fund, or any fund in which you want to invest, the first thing you want to do is look at expense ratios, right? And this is just how much the company is charging you each month to invest in that fund. For the portfolio manager to manage those assets or those stocks within that fund, how much are they charging you? And we've seen a massive drop in expense ratios over the past decade, over the past 5 years. Really a race to the bottom from Vanguard, Charles Schwab, iShares. All the major fund companies have really been lowering their ratios, their expenses, quite a bit. So that's great, but you always want to look and make sure that the expense ratio is lower than maybe some of the ones compared to it. And you always want to look, just like in stocks, where you compare stocks within the industry against each other. You don't compare, a tech stock against a consumer staples stock, right? You compare a tech stock with a tech stock. in funds, you always want to compare that expense ratio in other alternatives within that theme. Okay, so if you're looking at dividend funds, you want to compare the expense ratio within dividend funds. Okay, you don't compare the expense ratio in a dividend fund with one that's in like an active management, leveraged fund or something. Of course, that one is going to have a higher expense ratio just because it's more actively managed. It's maybe a leveraged fund, something like that. So you really can't compare the two. But you compare the expense ratio. You also want to look for diversification across sectors, and this is hugely important. Something I think most people kind of miss when they're looking at funds, especially dividend funds, is how much does that fund have in each sector, maybe even each country or region wherever the fund invests in. And a great example of this is the SPY, the Spider S&P 500 fund. It's that main and really the most popular ETF out there, just because it covers shares of the S&P 500, the broad market. The SPY, people love to invest in that and think, I've got all the investment, all the diversification I need because it holds the entire market. Well, the problem here is that if you look into that SPY fund, the S&P, and you look into the S&P 500 index, the market itself, you'll see that just like 3 sectors are about 50% of the fund. You've got tech, you've got I want to say, and I should bring up the page, but I'm not going to. You've got tech, and you've got like 2 other sectors that are about 50% of the S&P 500. And they're growth stocks. They're growth sectors. They're sectors that have grown so much over the last 10 years that the market cap of those sectors is so high that they just dominate the S&P 500. Well, what happens is, of course, if you invest in that SPY, if you invest broadly in just the S&P 500, then you are highly exposed to any kind of market weakness, any kind of economic weakness, because you're in just these 3 sectors that are highly cyclical. Okay. So when that market correction does come, or the crash, or what have you, then that fund is going to fall quite a bit more than maybe another fund that might have a little bit more diversification in other sectors. Okay, there's 9 sectors of the economy. There's tech, there's healthcare, consumer staples, utilities, industrials, materials. So these 9 major sectors, you want that diversification across those, or at very least, you want to understand yourself as an investor. Whether you're a high-risk investor or maybe somebody wants a little bit lower risk, and be able to be diversified, in those sectors that kind of align with your personality, right? If you're a high-risk investor, then yeah, maybe you want a lot of your money in tech, in industrials, in those cyclical sectors that are going to swing back and forth pretty wildly with the economy. But if you are a buy and hold, a less risk investor, a risk-averse investor, then you're going to want to have more money in those safer sectors like utilities, telecom, consumer staples, healthcare, things like that. So you really have to watch for this diversification in these sectors, in these funds. Okay. And the third factor is just kind of looking at the fund itself, the returns to date. You can't just look at the highest yield in these funds. And I get this so much, and this is actually something we're going to cover tomorrow in Monday's video about high yield stocks, is that so many people, they look for the highest yield. And you get so many companies that have those very high yields, high single digits, low double digit yields. And it's just because the dividends haven't been changed yet. Maybe the company's in trouble, stock price is coming down so much that that dividend yield increases. Okay, because dividend yield is just the dividend divided by the stock price. So if the stock price comes down and the dividend stays the same, that yield is going to skyrocket. Okay, but what happens when the company looks at its cash flows during the next quarter, and the board says, hey, we can't support this dividend. They cut the dividend, and it's just a bad news all around. This usually isn't quite as bad for a fund that holds hundreds of companies together, but it can be the same thing for a fund. So you can't just look at the highest yield fund for the stocks you want to invest in. A good example is the Oppenheimer Ultra Dividend Fund, which actually targets like the 60 highest yielding stocks from the S&P 900, I think it is. And it has historically underperformed the Russell 1000 index. Just by blanket targeting those 60 highest yielding stocks, it's underperformed the index because, yeah, in those highest yielding stocks, there are some problems that you need to be aware of and you need to watch for. So now we're going to get on to those 4 dividend funds that I want to talk about. 4 funds I think that you can you can count on, you can look to for some of the best funds for not only high dividend yields but total return as well. Very important idea that you get into, that you look at total return. The first one we're going to look at here is the SPDR Portfolio S&P 500 High Dividend ETF. That's ticker SPYD. It's got a 4.17% dividend yield, and the expense ratio is just 0.07%. So one of the lowest expense ratios you'll find, and it's a great just kind of low-cost core fund, right? You're looking at a broad market exposure here, and at a low cost. It's returned 12% annualized since its inception. Now this one hasn't been around for that long, so that 12% is a little bit skewed because it didn't have to, it doesn't have returns from the like the 2008 stock market crash. So a little bit skewed there, but it's a good overall fund. Look at the holdings here. It's very heavily invested in real estate, consumer discretionary, utilities, which, consumer discretionary is a little odd here because you wouldn't generally think of that as high yield. But some of these other larger sectors like real estate, utilities, financials are those high yield sectors. So fairly well balanced. It's it still does have it could use a little bit better diversification. And for that, I want to look at the Vanguard High Dividend Index, ticker VYM. Now this one has a little bit lower dividend yield, 3.26%. A little bit lower expense ratio as well, not by much, 0.06% expense ratio. So another low-cost core fund, and this one is actually a little bit better diversified. That's why, given the two, I think I might go with the Vanguard fund here because, you do have a little bit better diversification, and you see that here. Basic materials, you see, industrials 8.3%, whereas I think on the SPDR fund it was much lower. So you don't have that overweight exposure in some of these. Some of these cyclical sectors like oil and gas. I think was a much higher exposure in the SPDR fund. This one, the Vanguard High Dividend Index VYM, has provided 15.5% over 10-year annualized returns. So a little bit higher total return on that, even though it's a little bit lower dividend yield. So definitely, look for a little bit more diversification and that total return. Next is probably my favorite fund, and anyone in the community knows this because I point this fund out constantly. You're probably tired of me talking about the Vanguard Real Estate ETF, the VNQ. 3.96% dividend yield, 0.12% expense ratio, so a little bit higher than those core funds, but still very low compared to a lot of other funds you're going to find. And not bad considering that this is a little bit more actively managed fund. This fund holds I want to say 80. Let's go to the holdings here. This fund holds 188 REITs, 188 real estate investment trusts. So great companies for dividend yields, and it's fairly well diversified across different regions of the country, different property types. You don't have a huge exposure to retail real estate investment trusts, so just 13.6% in retail REITs, which I like because they've had a big problem with they've got a big problem with that e-commerce trend, and a lot of these traditional retail spaces are having a hard go of it. So it's very well diversified, and when we're talking about these dividend funds, everybody wants to go dividend stocks and dividend funds, but you have to be diversified in that real estate portion as well. So a great way to add real estate exposure to your portfolio, get you out of some of that risk in dividend stocks. And like you saw in yesterday's or Friday's video on our portfolio update, this VNQ was 18% throughout the whole month of May. Okay, so it started in May with an 18% total return for the year, ended May with that same 18%, didn't suffer that 7% sell-off that we saw in the rest of the market. So a great way to diversify your risks in your portfolio and protect the money that you've earned there. Our last dividend fund that we're going to look at before we get to, I'm gonna show you a ranking, rank these 4 funds. So I show you a graphic there, and then I'm going to talk about that strategy that you can use with funds and stock picking to get kind of the best of both worlds. And this one is the AMLP. This is another one that I talk constantly about. It's also in our 2019 portfolio challenge because it's got lots of those same benefits as the real estate fund, as the VNQ. So the Alerian MLP ETF, ticker AMLP. It's a fund of, like we talked about before, a fund of those energy assets. Okay, so these are pipelines, storage facilities, things like that. Pays an 8.2% dividend yield. Okay, so one of the highest dividend yields you'll find from a fund. It has a little bit higher expense ratio, 0.85% expense ratio. It's a little bit more actively managed than some of these, but it's really hard to beat that dividend yield. And again, why I like this is, this is going to diversify your portfolio. You see here that most of these assets, most of them are midstream energy assets, so pipelines, gathering and processing. You've got some storage assets in there, but it's just a different sector of the economy than a lot of these other dividend stocks. So it's gonna protect your portfolio. It's gonna give you a lot of the tax bright advantages that MLPs get, and with this you get no K1 form. I know. So a lot of you want to invest in MLPs, but you're kind of hesitant. You're kind of scared of that K1 tax form that you get every year with an MLP investment. Well, with the fund, you don't get that K1 form, so it's taxed just like any other fund, and you can hold it in a retirement account and pass those taxes each year, tax deferred each year in those retirement accounts. So now looking back at the return on this, it's been tough. You had that huge sell-off in energy, in oil prices in 2014 that really hurt a lot of energy companies, and they haven't fully rebounded yet. So the longer term return on this one is skewed a little bit from that, but it's a great return over the little bit shorter term over the last couple of years, and then before that big sell-off as well. I actually did some research for a corporate client once, comparing the dividend yield, the yield on the 10-year treasury, and the return on the AMLP, or the dividend yield on the AMLP. And what happens is, if you look historically over where that dividend yield on this fund has been versus the 10-year treasury note, so 8.2% on the fund right now, 2.07%, 2.1% on the 10-year treasury right now. If you look historically at when the spread has been that much, when there's been that much of a difference, then the forward return on this fund has just been excellent. We're talking 20, 30, 40% forward returns on this fund. So of course, past history is no guarantee of future results, but some very convincing evidence that the total returns will be there for this fund. Now I've got one more graphic here on ranking these funds, kind of comparing over the last. Well, this is a year-to-date graph on these funds. So you'll see the VNQ has just outperformed, and a lot of that is that interest rate exposure. Obviously real estate is very highly leveraged in debt. So anytime you've got rates coming down, interest rates coming down, then real estate tends to outperform, right? Because their funding costs get lower. So this VNQ, this Vanguard Real Estate Fund, has done 20% year to date, outperformed all the others, outperformed the market by about double. Then you've got looks like the AMLP is next with 11.7% return year to date. The VYM, so that Vanguard core broad market, has done 10.7%, and then the SPYD has come in at a flat 10% yield to year to date, which is right around where the market has been so far. So now I want to talk about that strategy to use both of these to get really the best of both worlds. I know a lot of you want to pick individual stocks. You want maybe a little bit higher return than the market if you can. And then some people just want those funds. But I'm going to tell you a strategy that I use that is really the best of both worlds. It's going to help you get that stress-free fund strategy. It's going to help you get those market returns and those high dividends, but it's also going to help you juice your portfolio return just a little bit with maybe some individual stocks. And this is called the core satellite strategy. Okay, and some of you might have heard me talk about this before, and basically because it's the strategy I use, the strategy I used with private wealth clients when I was working in that industry. Because it is so effective. It is such a great strategy. And what happens here is with the core satellite strategy, you take your whole portfolio and maybe 70% of that, 65 to 75% of that of your strategy. So you have $100,000 to invest, 75,000 you just put into these funds. Okay, not necessarily just the dividend funds, right? You've got a diversified, broad exposure into different types of funds. So your bond exposure, your bond funds that can go in there, your stock funds, your real estate funds, that Vanguard Real Estate ETF, the AMLP, to get that exposure. So it's just broad market exposure in these funds. And what that's going to do is, it's going to give you those dividends from that. It's going to give you that market return. It's just going to be a stress-free way to invest your money. That buy and hold these great low-cost funds for 20 or 30 years, and you'll never have to worry about them, right? Then what you do is you take the rest of your money in your portfolio, 20, 25, 30%, and you invest in that group of individual stocks that you really love. Now, we're talking, no more than 10 or 15 individual stocks. If there's one thing I want you to get from the channel, from the investing videos on the channel, is that you can't just watch a YouTube channel, you can't watch CNBC and just get a list of stocks and pick, and invest in 30 or 40 individual stocks just from that. You have to do your own analysis, and you got to keep up with that analysis every year, rechecking those stocks to make sure that they've got the competitive advantages. They're the best of breed stocks that you really want to own. So what limiting your part of your portfolio into those stocks is going to do, it's you've only got 20 or 25%, so you've only got enough money to maybe put into 10 or 15 stocks, right? So that limits the number of stocks that you're probably going to invest in anyway. That's just going to help you save some time, be able to only focus on those very high quality stocks that you truly believe in, right? But of course, because you're doing that analysis, you've got that individual, that handful of really great companies, then it's going to give you the chance to do a little bit better than the market return you get from the funds. Okay, so maybe you get another 4 or 5% total return on those stocks compared to what you would if you had 100% in funds. So just a great way to make your portfolio, make your investing strategy stress-free with the majority of your portfolio, but still get those extra returns. So now I want to open it up to Q&A. I've seen a lot of good comments come across, and I'm going to scroll up and try to catch a lot of those comments that came across. But if I don't get your question, or if I don't see it, just go ahead and ask it again in the chat there, so I can make sure that I see it. Again, thank you everyone for joining us here. And this is my favorite part of the live stream each week, is just kind of talking back and forth with you, looking at your comments in the chat window here. Okay, hello from England. Wow, England. We've got Ireland, Tallahassee. Another one, the SPHD, fairly safe and not very volatile. And actually, a good point that I wanted to bring up, talking about these dividend funds, and especially the low-cost core funds like that SPDR portfolio, the Vanguard High Dividend Yield. There are other dividend funds that are going to be just as good, really, and you could probably go into. I think this SPHD is probably another good pick. Very low cost, very low expense ratio, well diversified, more or less. I think I picked the SPDR, the SPYD here, just because it was a little bit more diversified. I'd have to check on that again. But yeah, a lot of these funds are going to be very similar, just different investment companies offering them. Use those 3 factors that I talked about, expense ratio, diversification across sector, total return instead of just the highest yield, to really pick, between funds. What else? What are important variable to evaluate an ETF product? So definitely you go through those factors. Look at the expense ratio, look at the diversification, because most of these, especially dividend funds, they're going to be passively managed more or less. The manager is going to have a set criteria of what he or she can invest in as far as stocks, or they just have to follow a pretty passive index. So the manager isn't going to really have a whole lot to do. They're just following this index and these rules to invest in. So a lot of these different funds, especially the dividend funds, like I said, can be very similar across Vanguard, iShares, BlackRock. So they're going to be very similar. Don't feel like you have to get the absolute best one, because your total return difference is probably going to be maybe 1% or 2 over the long term. And we've got, can you please suggest stocks to buy like you did with Campbell Soup? I'd like to. I mean, not really a stock picking live stream. We've got. I will do another stock picking live stream, maybe not next week, but the next week, and I've got some videos coming up on how I pick stocks. I've got one video that's going to be very exciting coming up. It's on how I pick IPO stocks and whether you should invest in an IPO. I had a lot of people ask for the video, so I put it together, kind of how I looked at IPOs when I worked for venture capital firms. Private investments, IPO investments, working for those venture capital, those early investors, how I looked for stocks, and so I'm going to share that. So not necessarily, not going to talk about how to pick individual stocks right now. I want to keep it a little bit broader, but I will definitely get to that. Thank you for the suggestion of investing. You're welcome, Darnita. Always love to see the people that come back, every week for the live stream and have this conversation. It's really nice. I really appreciate it. If you have 100 shares of stock with portfolio value 1,000, if I sold weekly covered calls and $50 premium, how come my balance is not 1,050? When can I withdraw that 50? With your covered call strategy. So actually a great option strategy, one that I use, and it really helps to protect your risk on a lot of stuff. Is basically selling someone else the right to buy that stock away from you, and they pay you a premium for doing that. So what they're talking about here is that, okay, if you've got $1,000 in the stock, you collect $50 from selling these calls to someone. When can I use that $50? When can I invest it? And the thing is, a lot of these investing sites, the platforms, they want to account for that. There's still risk in that. You still got, basically it's an unlimited risk, because if that stock goes through the roof, then you still got to sell it for that amount. So that $50 isn't necessarily yours yet. They want to keep that in reserve. So when those calls expire, that's when you'll have that $50. Basically the value of that call will dwindle all the way down to the intrinsic value by the time the stock the call expires, so gradually you'll be able to use that extra money. But when you first sell the call option and that your account shows that extra $50, then you still got, that's still like a liability, right? That $50 premium, that's still a liability. So as that, you have to wait till that comes down to zero, or comes down to the intrinsic value anyway of the call, to be able to actually use that money. What else? Can you suggest more strategy you're using on Morningstar? Not quite sure what you mean there, what the question is there. I use your Morningstar as it's kind of data research. They've got great financial information there. So you get all the company's finances, stuff like that. Not necessarily strategies that I use, but just information that I get from them. What else? Took a bunch of short positions on retail. Was doing good then recovered. Should I sweat the dividends and hold on? Okay, so that's a good question, because when you short a stock, then you have to pay all the dividends that those companies pay. Retail's been having a tough year, tough many years actually, and I haven't really looked at kind of the ebb and the flow of the stock prices. With that kind of trading idea, then obviously you really need to look to investor sentiment. I know, I read a book a couple of years ago, can't remember what it's called, but basically it was saying, and it's very true, that stock prices, within a year are all about investor sentiment. Okay, you've got fundamentals that exert themselves, financials, earnings growth that exerts itself over the longer term. So you can find companies that have those strong fundamentals, those strong financials, and are going to grow. Find those for long-term picks. But year to year, within a year, it's all about investor sentiment. What investors are paying for those earnings. So for any trading strategy, it's all about investor sentiment. You got to look at, okay, have investors beaten these stocks down enough to where any news is going to be good news. And I think a lot of the retail companies have been hurting especially bad lately. So it might be time that they come up temporarily, a temporary rebound. I don't think they've fixed their problems, so I think that the overall trend is probably going to be lower and downward, especially for a lot of these larger department store retail companies. But if you're shorting, if you're doing that trading strategy, then yeah, you really have to make sure that you're in and out at a good time. Greg asks, could you explain how expenses are taken from an ETF and how it affects the NAV liquidity? Not a whole lot of effect on the liquidity. Expense ratios, expenses generally taken, and I'd have to check actually. It's been so long since I've actually looked into it. But expense ratios are quoted on an annual basis, so that 0.07% annual expense ratio is an annual basis. But I think they take it out more on like a monthly basis. I'd have to check to see when exactly they're taking out. It might be different for each ETF. The thing is, especially with a lot of these funds that we've talked about and a lot of the funds out there, the expense ratio is so low that it's really almost negligible. I mean, we're talking 0.07%. So that's not even a percent. That's not even 0.1% expense ratio on that. So whether it comes out monthly or whether it comes out the entire year at once, you're probably not even going to notice a whole lot of it unless you've got a huge position in one fund and you just notice 10, 20 bucks comes out all at once. What's your opinion on LMT? I haven't looked at LMT for a couple of weeks or months even, but like we talked about, I think in our trade war live stream, I don't know if it was last week or the week before. It's not a trade war with China. It is a Cold War. It is a developing, evolving Cold War, and that is going to that's going to mean longer term profits, sales and support for these aerospace and defense funds. So not only are we seeing an increase in defense spending and likely very strong long-term support for defense spending, but these other aerospace, so going to the moon, going to Mars, these aerospace companies are doing well as well. Of course, with the exception being Boeing, because it's got its own problems. So you definitely want to do more analysis in LMT itself. Make sure that it hasn't gotten too far ahead of itself. Look at the debt, look at the the earnings and that kind of thing. But long term, I really do like those defense names. LMT, Raytheon actually just announced they're close to a merger with the aerospace division of United Tech. So that might create a pretty strong competitive advantage in that company. I think it's going to all be go under Raytheon's name. So Raytheon, LMT, some of those other defense names. Should I still be buying KO stock even though it's hitting 52-week highs? It's hard to justify paying some of these stock prices. I will say that Coca Cola is actually in a video that I'm doing that I just finished, and it'll be up within the next few weeks. That talking about investing in the stock as a part of a passive income dividend investing strategy, because it's hard to beat the scale and the distribution of Coca Cola. They are diversified across different drinks, not only soft drinks, but juice, milk, pretty much everything you drink into your body. So some great competitive advantage. They've actually been going into an asset-light model over this last year, which is why it's been hitting that 52-week high. They've been selling off refranchising a lot of their bottling partnerships. So, taking those assets off the book and really becoming more efficient and higher profitability. So yeah, it's been reaching those highs, but could still be a good investment to come. And long term, it's you can't be beat for dividend and safety there. What else do we have? In the VIYM, is real estate included in the financial? I think it might be. I'd have to check and look at the prospectus, but it probably would be. But it's something you definitely want to check if you're balancing it with that Vanguard real estate fund, maybe not to get too much exposure in that. What else do we have here? Still hurting the VD Vanguard. Yeah, energy has been tough over the last few years, but sometimes the best times to buy. I'm not quite sure what you mean on the 25-75 rule as it applies to MLP funds. So like the core satellite strategy, I guess. And what I mean with the core satellite strategy is you're taking your entire portfolio with that 75-25 split. So within that, I mean, you can do that by asset classes as well. So how much you want to invest in stocks, how much you want to invest in bonds, and how much in real estate. Whether you include MLPs within that stock portion or have its own section. Maybe I think I have about 10% of my total net worth in MLPs, maybe a little bit lower. So whether you want to separate it out from stocks or not. But what you can do is in each of these asset classes have a core satellite strategy in there as well. So within stocks, within the portion of the 60-70% of your money, total money you have in stocks, then 75% of that is in funds and 25% is in individual companies. Within bonds as well, you can have individual bonds and funds. Within real estate, you can have maybe real estate investment trusts, or maybe the broader VNQ fund, or maybe an international fund. I think that's the RWO is the Vanguard International REIT fund. You can have that as your core part of your portfolio, and then individual REITs as the satellite. So again, with MLP funds, if you have your MLP assets that you want separated from everything else, then you take maybe 75% of that, you put that in the AMLP, and then with the other 25%, maybe you pick out a few individual MLP funds that you can invest in. And of course, like we said, you want to separate that. The AMLP, the fund, goes into a tax-free or tax-deferred retirement account. The individual MLPs go into a regular taxable account. Okay. Let's turn it into DIV. Yeah, I haven't looked at the DIV as far as the price action on that. The thing I will say about funds, it's very hard for a fund to be a dividend trap in itself, because it just holds so many companies. Individual companies, like we talked about, individual companies within that fund can be a dividend trap, but it's very hard for the fund itself, unless the manager has been kind of going rogue and investing in more of these very high yield investments that might be dividend traps themselves. So what happens if you hold the AMLP in a taxable account? It's just going to be just taxed like any other fund. Okay, and I'd have to check to see how much of the AMLP dividends are qualified dividends, if they are. I think the AMLP, the dividends you receive from there are pretty much the same as any other ETF. So it's going to be, you're going to have qualified dividends in there. The prospectus will break it out, or the annual tax form will break it out for you. But it's basically just going to be you're going to be paying income taxes or taxes every year on those dividends you receive. So definitely hold that in a retirement account. Is there a commodities fund? There is. I don't. I didn't really look at a whole lot of commodities funds. I'm not big on direct investment in the commodities unless it's with a professional commodities broker or a commodities account, because commodities pay nothing until you sell them. So I'm much more interested in buying the miners. So like maybe a miners fund. The gold miners fund, I want to say GDX is the ticker for that, the GDX gold miners fund. That way you at least get those dividends. Gold miners can be profitable even as gold, the price of gold is a little bit lower. They can be profitable. They can be creating those earnings, creating that positive stock price appreciation. Even though, even while if you were investing directly in the metals themselves, you wouldn't be making money, or maybe you'd even be losing money because the price would be going down. So there's that. What else do we have? Do you think it's a good time to buy Chinese stocks? So Mohammed asks if it's a good time to buy Chinese stocks. Alibaba, other China stocks, does U.S. market crash cause falling Chinese stocks too? Well, and I think it's a great time to buy Chinese stocks. Haven't looked at Alibaba in a couple weeks, but it's a very strong company. It's basically the Amazon of everywhere else except America. Okay, Amazon's got a pretty good lock on the U.S., but Alibaba is really expanding its influence outside of China and really globally. So Alibaba is generally for longer term, I think, a great pick. Some of these other Chinese stocks as well. We own the LFC, so China Life in our portfolio. We own the FXI, which is a China fund. And okay, so your second question there, does the U.S. stock market crash cause falling Chinese stocks too? There is going to be some contagion effects, is what they call them. Contagion being that if investor sentiment crashes in one country, especially a country as large as the United States, then obviously that's gonna affect stocks in other countries. It's not a one-for-one relationship though, and that's a big reason why you want to diversify into not just American stocks, American companies with Chinese sales. You want to diversify into Chinese domestic companies, okay? So Alibaba, so Tencent, so China Life, that kind of thing, because that relationship isn't one-to-one. China's economy could be growing at 5-6%, even if the U.S. economy goes into a recession. So you're still going to have some good upside potential over there, and if nothing else, it's gonna smooth out your overall portfolio. What else? I think you really didn't understand the expense ratio with ETF. So the expense ratio is, so with an ETF, an exchange traded fund, just like the old mutual funds, somebody is running that. A company is managing that fund, and like I said, most of them are just buying the index, so buying the S&P 500 or buying a portion of that, or they've got rules about which stocks they invest in, but there's still a lot of expenses they have to pay. They have to pay the portfolio managers, the analysts, everybody within that company. So there's an expense ratio, an expense that you pay to own those shares of that fund. Okay, so whereas if you buy shares of Coca Cola, you can hold those forever. They don't cost you anything to hold them because you just own shares of Coca Cola. If you hold a fund, there's people that are managing that fund, incurring expenses on their side, and you have to pay them to be able to own that fund. So the expense ratio is just a percentage of it's basically the assets of that fund, but it comes down to per share. You can think of it as a per share expense as well. That percentage of the stock price that you have to pay. Okay, because the stock price is related to the asset value of that company. So just know that it's an expense you pay that comes out of your investing account for the total investment value that you have in that fund each year, and look for the lowest ones, obviously. Funds can't hold more. Okay, what other questions do we have? Can you please share a link to your M1 Pi for the investment challenge? It's kind of hard to share links while I'm doing this. I will put a link in the video description below to the investment challenge. If you want, you can just go to the homepage for Let's Talk Money, go to playlists, and it's the 2019 Stock Market Challenge playlist there. And then that'll have all 7 videos in that stock market challenge. It shows the fund or the portfolio, how it's developed. I think I started with 10 stocks, but now we're up to maybe 14. So it's like 7 stocks and some dividend funds and some other funds and that kind of thing. But I will share that in the in the video description. Buy a div because the monthly pay dividend. I'm in the dividend trap because it seems like the price continues to fall faster than dividend can make up for it. Yeah, and that's the kind of thing with dividends is you really have to look at the diversification to make sure that it's not overly exposed to one specific sector. So if the sector comes into trouble, economic trouble or cyclical trouble, then that helps for it. But yeah, I haven't looked at the DIV lately, so I don't know exactly what sectors it's in or why. Maybe it's losing value faster than some of these other dividend funds. You got to understand that during May, almost all dividend funds are gonna have lost value, other than that Vanguard REIT that we looked at, just because they're general market funds for the most part. So we are coming on a little over an hour for this live stream. I want to wrap it up a little bit. Again, thank you so much for everybody for being here. I appreciate it. I enjoy these back and forth that we get every week for the live stream. Please, if you ever have a comment or feedback or advice, I love learning from you as well. Just ask it in the comments or put it in the comments to a video. I read every single comment we get. And look for those videos coming out this week. Going to be some great videos tomorrow. That high yield investments ranked video, the five highest yield stocks that I like. One of them a 30% annualized return over the last 3 years, so huge return plus that high dividend yield. And then those passive income investments, passive income idea videos that we got Wednesday and Friday. But I will, with that, I will close it up, and I appreciate it. Thank you all for being here, and I will see you again next week.